Imagine you could see exactly where the big players in the market, hedge funds, institutions, smart money, are placing their trades. Imagine if you could understand the market, not just by looking at price, but by seeing the volume behind every move. Would that change the way you trade? Welcome to this in-depth exploration of one of the most powerful tools in a trader's arsenal, the Fixed Range Volume Profile, or FRVP. Whether you're brand new to trading or a seasoned chart reader, this video will teach you how to use FRVP, how to interpret it, and how to build real-world strategies around it. This isn't a surface-level overview. This is a complete masterclass. Before we dive into FRVP specifically, let's first understand what Volume Profile is. Volume Profile is a technical analysis tool that displays trading volume by price level. Unlike traditional volume bars that show volume against time vertically at the bottom of a chart, Volume Profile is horizontal. It shows where trading volume happened at specific price levels over a period. Think of it like this. Price tells you what the market did. Volume tells you why. It appears as a histogram, horizontal bars on your chart that grow longer where more volume occurred at a specific price and shorter where there was less volume. This information is vital because it tells you where the market participants were most active. Volume Profile helps answer questions like, where is the market likely to find support or resistance? Are current price levels accepted or rejected by the market? Are we in a balanced or imbalanced market state? Volume is often called the fuel of the market. When volume is high at a certain level, it means that a lot of market participants agreed on value. When it's low, it means there was no consensus, and price tends to move quickly through those areas. Now let's narrow in on the Fixed Range Volume Profile, arguably the most powerful and precise version of Volume Profile. It allows you to manually select a specific section of your chart. Instead of showing volume for everything on screen or using auto-calculated sessions like daily or weekly, you define exactly which range you want to analyze. This could be a trend move, a consolidation zone, the price action around a news event, or a custom time frame of your choice. FRVP then calculates and plots the volume at price data within only that range. This gives you a surgical view into what was happening inside that zone. Did buyers dominate? Was volume building or drying up? Were there signs of absorption? This level of focus is perfect for hypothesis testing, pattern validation, and for analyzing the behavior of large players during key events. It's especially helpful for traders who want to understand institutional behavior within precise zones. Let's break down the key elements that make up every FRVP histogram. Point of control, POC. This is the price level with the highest traded volume within your selected range. It's where the most buying and selling occurred. Think of it as the market's idea of a fair price. Price often reacts at the POC, making it a great level to watch for entries, exits, or rejections. Value area, VA. This is the range where approximately 70% of the volume occurred. Value area high, VAH, the upper boundary. Value area low, VAL, the lower boundary. Price tends to consolidate inside the value area, but if price breaks outside VAH or val with strength, it could mean the market is finding new value, leading to breakouts or breakdowns. High volume nodes, HVNs, these are the peaks in the volume histogram. They signal areas where the market spent a lot of time in volume. Low volume nodes, LVNs, these are valleys in the histogram, price levels that were skipped over quickly. Price tends to move fast through LVNs due to a lack of participation. These are great areas for breakout strategies. Now let's understand how price react to this key element of FRVP. Price near POC, point of control. When the price hovers around the POC, it indicates a balanced market where buyers and sellers agree on value. The point of control also functions as a strong reference for potential reversals and significant support or resistance. The POC can serve as a crucial pivot point for traders, presenting opportunities for trade entry or exit. For example, in an uptrend, if the price pulls back to the POC, it often finds support before continuing its upward movement. Conversely, in a downtrend, the POC can act as a strong resistance level. When price moving away from POC, say a decisive move away from the POC, suggests an imbalance, signaling potential trend initiation. Trading the value area, VA. When the price is within VA, between VAH and VAL, the market is in a state of equilibrium. Traders can look for range-bound strategies, buying near VAL and selling near VAH. Prices within the value area tend to exhibit fewer volatile moves due to a lot of liquidity, while prices outside the value area tend to show, quote, sharper moves because there is less liquidity. This establishes a clear causal relationship. High liquidity, represented by high volume at a price level, leads to lower volatility and consolidation as orders are easily absorbed. A breakout above VAH or below VAL, especially with increased volume, can indicate the start of a new trend. Now let's talk about high and low volume nodes. High volume nodes. These are price levels with significant trading activity, acting as strong support or resistance zones. Price tends to consolidate, pause, or reverse at HVNs, requires substantial momentum to break through. On the other hand, low volume nodes are areas with minimal trading activity, often leading to rapid price movement when entered due to lack of interest or represents unfair value areas with low liquidity. Price tends to move quickly through LVNs with minimal resistance. One of the most insightful features of the fixed range volume profile, FRVP, is the identification of volume shelves. These are areas on the chart where trading activity has been highly concentrated at specific price levels, creating a, quote, shelf-like appearance on the volume histogram. Volume shelves are horizontal areas on the volume profile where a significant amount of trading has occurred, indicating strong interest and agreement between buyers and sellers at those price levels. These shelves often act as robust support or resistance zones. When the price approaches a volume shelf from above, it may find support. Approaching from below, it may encounter resistance. Traders can look for entry opportunities near these shelves, anticipating a bounce or reversal. For instance, entering a long position near a volume shelf acting as support, or considering a short position near a shelf acting as resistance. In contrast to volume shelves, volume gaps are areas on the volume profile with minimal trading activity. Volume gaps are regions where the volume histogram shows little to no activity, indicating a lack of interest from market participants at those price levels. Prices tend to move swiftly through these gaps due to the absence of significant support or resistance. This can lead to rapid price movements until the next volume shelf is encountered. Traders can capitalize on these swift movements by entering trades as the price enters a volume gap, aiming to exit near the next volume shelf where the price may slow down or reverse. By effectively interpreting volume shelves and gaps within the FRVP, traders can enhance their market analysis, identify key support and resistance levels, and make more informed trading decisions. Now, let's dive into how volume profile shapes can reveal market sentiment and predict future moves. Spotting these patterns is crucial for effective trading. First, there's the D shape. Picture a classic bell curve. This means the market is in a sort of holding pattern, with buyers and sellers fairly balanced. Think of it as a period of sideways movement. Sooner or later, this balance will tip, and the market will likely make a move. Next up is the P shape. Imagine a profile that's wider at the top and thinner at the bottom. This often tells us that more trading is happening at higher prices. Now, this could be good news. A bullish sign if it happens after a quick price jump and then some settling. But if it forms when the market is already at a peak, it could signal that prices might be about to fall. Often, after a P shape, we see a small dip, which some traders see as a chance to buy. Then we have the B shape. This is the mirror image of the P shape, thin at the top and wide at the bottom. This pattern usually appears when the market drops sharply and then levels out at those lower prices. After a B shape, we often see a temporary bounce upwards. Some traders use this bounce as an opportunity to sell. Finally, there's the B shape. Think of two separate D shapes stacked on top of each other, like a capital B. This shape usually means a trend is continuing. The market settles at one level, breaks out to a new level, and then settles again. Even though a chart technically has only one true point of control, or POC, in a B shape, both of those D areas are important. The one with the overall POC is generally the stronger one. By understanding these shapes, traders can get a better feel for the market's structure and what might be around the corner. Now let's talk about strategy. How do we actually trade using FRVP? Strategy 1, HVN retracement entries. If price returns to a previously established HVN, Expect it to act as support or resistance. These are ideal zones for limit orders. Strategy 2. LVN breakout triggers. LVNs are low liquidity zones. When price enters them, it often zips right through. Place stop or trigger orders around them for breakout trades. When you manually execute a trade in a low volume nodes, the problem of the price moving fast and you getting filled at a worse price than expected. Strategy 3. Value area breakouts. If price breaks above VAH or below VIL with strong volume, it often continues in that direction. These areas are ideal for momentum entries. I personally prefer to enter the trade if the value area is narrow and consolidate for a longer period. You can use volume bar to confirm the breakout. You will often see increase in the volume bar. Strategy 4. Multi-time frame confluence. Use weekly FRVP to find strong HVNs and VAH zones. Then drop to the intraday level and look for alignment. When higher and lower timeframes agree, your odds of success improve dramatically. As powerful as FRVP is, it's not perfect. It's a reactive indicator based on past data. It requires good data feeds. Inaccurate data can skew your histogram. I use futures instead of spot indices, and it's subjective. Different ranges yield different profiles. Don't overfit. Use it consistently and always combine it with solid trade management. If you made it this far, congratulations. You now understand the market not just through price, but through the lens of volume at price, where the real battles between bulls and bears happen. If you found this video helpful, smash the like button, subscribe, and let me know in the comments what strategy you're most excited to try. Thank you for watching.